Hey everybody, David Lenevieux with Rockmore Wealth Management. This week I want to talk to you guys about fixed income, also known as a bond or a GIC, a guaranteed investment certificate. But the real question I want to ask is fixed income really as safe as everybody thinks it is? Now, before I get into that, what exactly is fixed income and how does it work? Well, let's really simplify this process and let's talk about a GIC that you would go buy from your bank or credit union. Typically, what most people can do is you go to the bank or the credit union, you take $1,000 in, you deposit it with that institution, and when you deposit that money, the institution says, hey, no problem, we're going to take your $1,000, and as long as we have it, we're going to pay you 2% per year. And at the end of the term, call it 2 years, we'll give you that full $1,000 back and we guarantee it. And that in of itself is a very simplistic way to paint a picture of what fixed income is. And now that's with a GIC. Other fixed income products out there are generally bonds, which people may be familiar with, and that can be offered by the federal government, the provincial government, and bonds can also be offered by corporations. And they're offered at all sorts of different rates of return or interest rates, and for all different lengths of time. However, what most people don't realize is the bond and fixed income market is extremely complex. It can also be extremely volatile, and the bond market is much, much, much larger than the stock market. There is way more volume traded in the bond market daily than the stock market, and it is a much bigger market as well. Now, to simplify things today, we're just generally going to talk about the Guaranteed Investment Certificate or the GIC because that guarantees you no matter what that you get your money back. So when we talk about the safety of fixed income and specifically GICs, we have to look at the short term and then we also have to look at the long term. So you've heard me say it many times before, if you know or you need a certain amount of money within a short period of time, we will tell you 100% don't invest your money with us. Don't invest it into the stock market. Go to your bank, buy a GIC, put it in a high interest savings account because you know that you'll be able to get that money back and pay for whatever purchase you're planning on buying in that short time period, anywhere from today to 2 years from now. Because what you don't want to happen is you don't want to go invest your money and hope to buy a house in 2 years and then realize that the market just took a fall and that $100,000 that you put away is now only worth $80,000. We don't want that to happen. We want to guarantee that we can give you that $100,000 back plus a rate of return. However, what happens when we talk about fixed income long term? And I'll start it off with a quote from one of the most well-known and best investors that have ever lived, Warren Buffett. And Warren Buffett's quote is, "Fixed income is the riskiest asset anyone can own long term." Now, why is that? And it's a little bit counterintuitive because we just said to you that fixed income guarantees you to get all your money back plus a rate of return. Well, the problem with that is the rate of return doesn't necessarily match what inflation is going to be. Because when it comes to investing, inflation is one of our biggest enemies because it slowly erodes our purchasing power every single year. So let's take a typical portfolio that has over 40% of the money in fixed income or bonds. Well, if it's only earning 2% a year, and inflation is 2.5% per year, and this is a typical scenario, you've actually guaranteed yourself a loss long term. And that's what makes it extremely risky because who wants to lose money long term? And 0.5%, that's very significant when you talk about a long-term time horizon. So I'm going to agree with Mr. Buffett and also say that fixed income long-term is one of the riskiest investments you can ever own. So why would you ever want it as a major portion of your portfolio? because 40% is a lot of your money in an investment that's going to lose you money long term. And we see it even compounded because the typical thinking has always been, as we near retirement, we need to shift more and more of our portfolio away from the stock market and into fixed income. So now you have 50% fixed income or 60 or 70% of your portfolio in fixed income. And in my opinion, that doesn't make any sense. Because listen, typical people will retire between the ages 60 and 65. Now, reasonably, we're going to hope that you're going to live for the next 20 or 30 years. So you're going to need to live off this money that you've put away for the next 20 or 30 years. Do you really want to guarantee yourself a loss over the next 20 and 30 years? Because that inflation is going to eat away at your purchasing power every single year, and you're going to have less and less and less money to live on. So what should you actually do? Well, guys, don't get me wrong. I'm not a proponent of just stocks and bonds. I really believe that you need to have some other items in your portfolio, but that's a conversation for another day. So we're going to just talk about fixed income. My belief when it comes to fixed income as part of your portfolio, as you're in your accumulation stage, so as you're growing your money, realistically, you're going to have very, very little income in fixed income in your portfolio. Now, we do have to base it on what your specific needs are and what your specific risk profile is. But reasonably, we're going to have a lot less fixed income because you have no income need as you're accumulating money. But as we do turn to retirement, yes, we are going to have a need in the short term for fixed income, because remember, as you hit retirement, you're no longer working and earning money. You now have to draw money out of your investment portfolio. So now we do have a short-term need. So you are going to have a larger proportion of your portfolio in fixed income. But in our opinion, it's not even going to reach 40%. Now, depending on your income needs per month, we may need to make sure we put away maybe 2 years or 3 years or even 4 years worth of your overall portfolio into fixed income, so we can just guarantee you that every month that we can just continue paying you money every single month out of that fixed income pool. But the rest of your money is going to be invested elsewhere, and we'll just, for simplicity's sake, say it's in the stock market. Well, at a certain point in time, the stock market is going to take a major tumble. But us as managers, we're not really concerned about that, because we know we've already put away enough fixed income in your portfolio that we can continue paying you month after month after month, and even year after year. And then as the stock market rises, well, we've drawn down on your fixed income, but now as your money on the stock side has come back up, we can now start selling some of those stocks at good or great prices and refill your fixed income pool. Because the worst thing that you can do in a stock market downturn is sell great assets at terrible prices. So we do have to have enough of your money in fixed income to be able to guarantee you that stream of income for a certain amount of time. But once again, it's probably not going to go up to 40% of your overall portfolio. And now if we're really doing our job well, and we found out that we actually have an overestimated the amount of fixed income that you do have, and the stock market is in a downturn like it is today, well, maybe we can actually take some of that fixed income off the table, sell that, and use that money to go in and buy stocks at a great price. And we're going to repeat this process over and over again every couple of years. And that's going to allow us to grow your money reasonably over time, but also guarantee that we can give you the fixed income that we need every single month for the rest of your life. And guys, that's, in my opinion, how a portfolio should be properly constructed. But it also shows you some of the fallacies that people have when they think about fixed income as part of your portfolio. Guys, if you have any questions about any of this, you want to talk to me a little bit further, please go to our website, www.rockmorewealth.com. Get our contact information, get a hold of us, and we can sit down and talk about this one-on-one. Stay happy, stay healthy, and we'll look forward to talking to you guys on another topic next week.